Welcome to the Deep Dive, where we unpack the most important nuggets of knowledge to get you well-informed, fast. Today, we're diving into the second quarter 2025 results from Vista Energy. They're that fast-growing shale player down in Argentina's Vaca Muerta Basin. And this was a quarter that really grabbed the market's attention, maybe not always for the reasons you'd think.
That's right. This earnings call, it really showed a period of, significant strategic transformation for Vista Energy. But it was coupled with some notably mixed financial signals. Definitely caused some market jitters. So we're going to walk through the operational wins, get into the financial specifics, and try to read the signals from management about the road ahead. Our goal today is really to help you understand the full picture behind those headlines.
Okay, so let's jump right into the snapshot then, the results. Vista Energy reported revenue of $610 million. Now that actually surpassed the consensus expectation, which was around $572 million. So, a pretty solid top-line beat right there.
It was a revenue beat, yeah, but here's where the picture gets a bit more complicated. Adjusted earnings per share, the EPS, came in at just $0.55. That was a really substantial miss compared to the $2.15 Wall Street was kind of looking for. So this big earnings shortfall, even with a strong revenue, it just created a genuinely mixed outcome for the quarter,
Right, but on the operational side, the numbers looked, quite impressive, didn't they? Production surged an incredible 81% year over year, hit 118,000 barrels of oil equivalent per day. That's huge.
Absolutely huge growth.
And that kind of operational performance sent their EBITDA margin, that's earnings before interest, taxes, depreciation, amortization, basically core profitability, sent it to a really robust 66%.
Strong margin. The market definitely cheered that production momentum, seeing Vista really solidify its position. But that wide earnings gap we talked about, and couple that with a significant negative free cash outflow, which was largely tied to that big recent acquisition, it drove a pretty quick sell-off.
Yeah, I saw that.
We saw a material slide in Vista's stock price the next day. And interestingly, even peer companies saw declines in sympathy.
Really?
Yeah, it really underscores this broader sector caution around, let's say, capital-intensive growth.
Yeah.
Even when the operational story looks strong.
Okay, that gives us the high-level picture. But let's really peel back the layers here and understand why this quarter was so pivotal for Vista. The second quarter of 2025, it was truly transformative, mostly because they completed their acquisition of that 50% stake in Marga Chica. And just for context, that's the second largest oil production block in the whole Vaca Muerta Basin. It's a big deal.
It is a very big deal. This acquisition, it isn't just about adding more land or potential drilling spots. It has fundamentally reshaped Vista. It actually positions them now as the largest independent oil producer and the largest oil exporter in Argentina. The CEO, he highlighted total production for the quarter at that 118,000 barrels of oil equivalent per day. That's an 81% jump year over year. Oil production specifically up 79% to 102,000 barrels per day. I mean, this move signifies a massive step change for the company. And for you listening, it means you're looking at a potentially much larger, more influential player in that regional energy market.
Okay, let's move to the financials in a bit more detail then. Revenue hit $611 million, up a remarkable 54% from the same quarter last year. And like you said, largely driven by that strong increase in oil production, which, importantly, more than offset the lower oil prices they saw.
Right, the price was down a bit.
Yeah, the average realized oil price was $62.02 per barrel. That's down 13% year over year. But here's a key point. 100% of their oil volumes sold were at export parity prices.
That is key.
It means they're getting those international market prices for all the oil they ship out, not, discounted local rates.
Yeah.
Big difference for the bottom line.
Exactly. And adjusted EBITDA came in at $45 million. That's a 40% increase year over year. Healthy growth there. However, the capital expenditure, the CapEx, was substantial, $356 million. And that reflects a really significant ramp up in new well activity, both in their existing top block and in that newly acquired La Marga Chica. So that spending, that's a crucial piece of the puzzle behind that earnings miss we mentioned earlier.
Right. So while those revenue and production figures look strong, the financial picture gets, let's say, more complex when we look at cash flow. A huge $1.4 billion free cash flow outflow for the quarter. That really caught the market's attention. And it's primarily tied to the upfront cash payment for that Petronas Argentina acquisition we just discussed, that La Marga Chica stake.
Exactly. That's the main driver. And the net leverage ratio, how much debt they have relative to earnings, ended the quarter at 1.38 times, which reflects the new debt they took on to finance this massive payment. Management actually broke down the negative operating cash flow too. They pointed to a $250 million income tax payment and increases in working capital, including, interestingly, a $45 million increase in VAT credit.
Okay, what's a VAT credit again?
Right. So it's essentially a prepaid value-added tax. They expect to get that cash back in the coming quarters. So it's more of a temporary drag on their cash position right now rather than, a permanent loss. It should reverse.
Got it. Okay, let's pivot to their operational efficiency then, because they talked a lot about that too. They connected 24 new wells during the quarter. 12 of those were in Marga Chica, their 50% share. And here's what seems like a critical point for future profitability. They've made real progress cutting new well costs. Drilling and completion costs are down to $12.8 million per well.
That's significant.
It is. It's a saving of $1.4 million per well. That's 10%. And they expect that saving to start showing up in their costs from Q3 onwards. I mean, that's a big deal for their margins going forward, isn't it?
A huge deal.
Yeah.
And this cost efficiency, it's actually coming from several places. It's multifold, as they put it. They're rolling out innovations like wet sand technology, which helps cut costs because they use local, unprocessed sand instead of trucking in more expensive stuff.
Okay.
And they're using something called Smart Light to improve drilling efficiency in the curved sections of the wells. Apparently, it shaves around 16 hours per well.
Wow, 16 hours.
Yeah, think about that. 16 hours saved per well across dozens of wells. It really, really adds up. They're also using real-time fracking monitoring. This helps optimize the size of the hydraulic fracture and avoid what they called runaway fracks, basically ensuring they're not overspending and not wasting materials.
Makes sense.
Plus, just good old-fashioned contract work. They've renegotiated contracts for specific consumables, and they changed their contract strategy. They've unbundled drilling rig services to get, better control and better pricing.
And did they mention something about oil tracking?
They did. In a move that significantly improved their margins, the elimination of oil tracking as of April 1st, that led to a $41 million saving compared to just Q4 of 2024.
41 million, just from that.
Just from eliminating that tracking mechanism, it's a direct boost to their bottom line.
What?
Pretty substantial.
Okay, so costs are coming down. What about guidance? What are they forecasting now with this bigger footprint?
Right. The updated full year 2025 forecast now fully reflects the larger scale post-La Marga Chica deal. Total production is expected to be between 112 and 114,000 barrels of oil equivalent per day for the full year. But the second half of the year, they're projecting an average even higher, 125 to 128,000 barrels per day. So that really sets them up strongly for continued growth into 2026.
And what about EBITDA guidance?
Adjusted EBITDA for the year is now forecast between $1.5 billion and $1.6 billion.
Okay.
Now, that assumes Brent crude prices average around $65 in the second half of the year. So, keep that assumption in mind.
Right. But what's really eye-opening here, I thought, was that even with the same capital expenditure level, they're sticking to $1.2 billion for the year. They're now forecasting 16% more production and a massive 70% more adjusted EBITDA compared to their original 2025 plan before the acquisition.
Exactly. That suggests this growth is coming very efficiently, despite that initial big cash outlay for the deal. It's accretive, as they say.
And the cash flow, after that big negative number this quarter?
Critically, management projects neutral free cash flow for the second half of the year, so break even overall for H2. They said it'll likely be a negative Q3, followed by a positive Q4. This, they argue, demonstrates their strong capital discipline, even with oil price volatility. It's meant to assure investors that the huge cash outflow this quarter was indeed a one-off thing tied to the acquisition. And looking further out, for 2026 and beyond, they were emphatic. They stated their model anticipates a positive free cash flow outcome alongside continued growth. That's exactly the message long-term investors want to hear, right? Positive free cash flow.
Definitely. Okay, let's drill down into the Q&A from the call. Did analysts push back on anything? What about those well costs and productivity in the new Marga Chica block? Any concerns there?
Yeah, that came up. Management addressed concerns about that. They acknowledged that initial production rates, the IP rates, might be slightly lower than their original block.
Yeah.
But they stressed it's not due to rock quality. They view the ultimate recovery of a well, the total oil you get out over its life, as more relevant than just the peak oil rate right at the start.
Okay, so longer term view.
Exactly. And their models show the Marga Chica is just as good as their other top blocks in terms of that long-term recovery.
And what about working with YPF, the operator there?
They really emphasize their strong collaboration with YPF. said they're actively exchanging technical information, finding synergies, things that are expected to improve both performance and costs for both companies. Which does raise an interesting question for you, the listener. How much more value can actually be unlocked through these kinds of strategic collaborations across the whole Vaca Muerta region? It points to the potential of the basin itself.
Good point. And what about their overall capacity for growth? Is there enough infrastructure?
They address that too. Based on current transportation capacity, they said they could produce up to about 144,000 barrels per day.
Okay, so still some headroom now.
Yeah, but looking further out, with their share of the Vaca Muerta capacity, and particularly when the new VMOS pipeline is delivered, they think they could eventually reach a whopping 200,000 barrels per day.
200,000 barrels, when would that be?
The VMOS pipeline is key there. Construction apparently started in May. The first stage, which can handle 550,000 barrels per day total, is expected to be ready by mid-2027.
Mid-2027. Still a ways off, but significant.
Very significant. And they just secured financing for it. A $2 billion syndicated 5-year term loan to cover 70% of the project cost. They highlighted this as a really strong vote of confidence from international banks in the Vaca Muerta's potential.
Okay, that makes sense. What about handling price volatility? Oil prices go up, they go down. How do they protect themselves?
Right, a classic question for any producer. Their philosophy on capital allocation in a volatile price environment is really worth noting. They highlighted 2 key protective drivers for their business. First, a very low cash cost base. They said it's around $20 per barrel, and that includes royalties and gross taxes, assuming a $60 realized price, so quite low break-evens.
$20 is low.
Very low. Second, they stress significant flexibility in their drilling and completion contracts. Because they have a very short capital cycle, they can adjust spending quickly.
How quick?
Well, this agility allows them to rapidly reduce their capital expenditure burn rate at a very low cost if needed. They actually pointed back to the COVID-19 pandemic as proof they could do this effectively. They confirmed on the call that if Brent crude prices were to consistently fall below, say, $55 a barrel, they could start cutting new well capital from their plan. They'd grow less, obviously, but they could protect their balance sheet almost immediately. And they could do it gradually, too, not just slam on the brakes.
So flexibility is key.
Crucial risk mitigation factor for them.
Okay, one last thing before we get to the investor context.
Yeah.
What about M&A? More deals coming and hedging.
On M&A, management confirmed they are, quote, always hungry for the right opportunity.
Yeah.
So yes, they'll continue to actively assess deals, but they emphasized a high bar. Needs value accretion and strategic fit. No deals for the sake of deals.
And hedging. Are they locking in prices?
They addressed hedging. They basically said, well, they have natural hedges like their low-cost operations and that flexible CapEx we just talked about. A formal financial hedging program is difficult.
Yep.
And expensive to implement in Argentina, specifically, given the current capital environment there. So, no big financial hedging program for now.
Okay. So let's bring it all together. What does this all mean for you, the investor?
Well, despite that strong production growth and the raised guidance, the market reaction right after the call was clearly negative, wasn't it?
Yep, the stock dropped.
Right. And this really underscores the market's sensitivity to the immediate financial impact of major acquisitions, specifically that big upfront cash payment for Marga Chica and its effect on free cash flow, plus that adjusted earnings miss. The market often focuses intensely on the here and now, on those reported numbers.
So what you're looking at here is a company undergoing a really significant transformation. It's scaling up rapidly by integrating a major new asset. And while the short-term free cash flow was negative, largely due to those one-off acquisition costs and some working capital normalization, management is clearly guiding for neutral free cash flow in the second half of this year, with a strong positive outlook for 2026 and beyond.
And this strong focus on cost reduction, the stuff we talked about achieved through tech innovation and better contracts, that suggests a real structural improvement in their operating model, should benefit them for years. You combine that with their stated flexibility to adjust CapEx if oil prices fall. It really positions them for resilience, even in uncertain times.
Yeah, the growth story in Vaca Muerta itself, it still seems compelling, doesn't it? Especially supported by that big VMOS pipeline project coming online and the collaboration with YPF. It feels like a balance, really, managing the near-term financial hit from this aggressive expansion versus realizing the substantial long-term value from a much, much bigger production base.
That's a good way to put it. For you listening, it's about weighing that short-term financial noise against the potential long-term strategic play here.
All right, this is the part of the deep dive where we put on our imaginary hedge fund manager hats. Quick disclaimer, this is absolutely not financial advice, just us brainstorming some, let's call them outrageous but plausible trade ideas based on what we just discussed.
Okay, so given Vista Energy's recent price reaction, that notable slide we saw despite strong operational gains and an increased full-year outlook, we see a potential disconnect, right, between the market's immediate reaction and maybe the underlying fundamentals. The market seemed to penalize them heavily for that one-off acquisition payment and the related earnings miss, possibly overlooking the underlying production strength and that improving future cash flow profile.
So here's the play, the trade idea. You could consider a long position in Vista Energy's equity. Okay, maybe not that outrageous, but specifically maybe buying out of the money long-dated call options.
Okay, adding some leverage.
Exactly. The outrageous part here is you're essentially betting on a strong rebound against the current market sentiment. You're anticipating that those operational efficiencies, the cost cuts, and especially the long-term positive free cash flow they're guiding for starting in 2026. That story will outweigh the short-term negative noise from the acquisition financials. It's a bet the market is currently mispricing Vista's longer-term potential.
Right. And the plausible angle to this admittedly aggressive trade, it hinges on the fact that the free cash flow outflow was largely a one-off event tied to the deal. Combine that with the structural cost reductions they're achieving and the massive Vaca Muerta growth potential, especially with VMOS coming online by mid-2027, well, it does create a genuinely compelling long-term value proposition.
Right.
One that might be undervalued right now in the immediate aftermath of a mixed, noisy earnings report. You'd basically be trying to capitalize on what could be an overreaction to a temporary cash flow hiccup, buying into a potential narrative shift from short-term pain to long-term strategic gain.
Interesting angle. Okay, so let's recap the whole thing then. Vista Energy's second quarter was, well, a true mixed bag, wasn't it? You had the revenue beat, good news. But then the earnings miss, bad news. And it was all kind of overshadowed by that significant free cash outflow tied directly to their transformational acquisition of Marga Chica.
But despite the market's immediate negative reaction, the company really did demonstrate impressive production growth. They showed substantial cost efficiencies are being locked in. And they reiterated a clear commitment to capital discipline, forecasting that return to positive free cash flow from 2026 onwards.
Yeah, the strategic moves like the Vaca Muerta pipeline development and those collaborative efforts with YPF, they really do underscore a potentially powerful long-term growth story in a critical global shale basin. So for you, the listener, it really comes down to whether you see the short-term financial pain as just a temporary blip on a much larger, significant growth trajectory, or is it a sign of deeper issues?
And as always, please remember, this deep dive is purely for informational purposes. It is absolutely not financial advice. The world of energy, capital markets, it's complex, it's volatile. Always do your own research. So after hearing all of this today, what stands out most to you from Vista Energy's Q2? What's the key takeaway you're mulling over?
We definitely encourage you to continue your own exploration. Thank you for joining us on the deep dive, and we'll be back soon with another deep dive.